Hello and welcome back to another video. Um, so today I'm going to be starting what I believe is one of the most important and critical steps when it comes to investing, and that is an investment prospectus as well as an investment procedure manual, which the whole goal is I'll break down like two sections at a time for each video. So like this video would be section one and two, and the next one would be three and four, and so on. Um, but so what I would like for you to do is get out a piece of paper or get out your laptop or something. And as we go through this, kind of like jot down, like put the title, the heading of the section, and then jot down your own idea or thoughts as we go through this, like kind of get your brain working a little bit. Um, but anyway, so uh, basically, what an investment prospectus is, it's like your core beliefs and also your strategies and any ideas that you have when it comes to investing. It's kind of like your foundation, your building blocks of your investments. So this is why I believe it's one of the most important steps, is because this is what when it comes down to it, when you boil it all down, this is why you invest and how you invest and your beliefs to your investments, basically. So it's basically like another term for it could be like your constitution. When it comes to investing, this is an investment prospectus is your constitution to your investment world. So, so going into the first section of your investment prospectus is your investment objective. So, what an investment objective is, it's basically something that we can use to determine the optimal portfolio mix for our portfolio. So, it's a way to choose investments based on guidelines or your investment objective. So basically, like, what is the purpose or the goal of your investment? So, are you investing for another source of income? Are you investing to, you know, grow your money over the next 10 to 15 years? Are you investing for retirement funds? Are you investing for your children's colleges? Just things of that nature. So, you got to first figure out what the purpose or the goal is of your investments. Um, Everybody's different. Nobody's the same. I mean, some people are the same, so, or some people are similar, but it's gonna vary based off of, you know, the person that you are and things of that nature. Um, and then next thing you want to look at for your objective is your time horizon. So going back to it, your time horizon has somewhat to do with your purpose or your goal of your investment. Is the so if your purpose or your goal of why you are investing was to increase the capital that you have for a down payment on your first house, your time horizon will probably be between that 3 to 8 year mark. So it might vary. Your investments might vary a little bit when it comes to it since it's such a short time horizon. But um, or is your time horizon, even shorter term? You're just trying to make extra income, so your time horizon might be 6 months. It might be 1 year, 2 years in that short time frame. You see, or it could be, you're investing for 20 years, you're investing for retirement, or you're investing for just having extra money down the road. but you're comfortable with being in the market for such a long time, then your strategy is going to be a little different from those that are investing in a shorter time frame. Your, yeah. So the objective is dependent upon your own, like what your objective is. So the objective, you might have a different objective from somebody else, and that's completely fine. And then how comfortable are you with risk? Are you risk on or are you risk averse? So when it comes to investing, risk, there, I would say there's a lot of calculated risk when it comes to investing in the markets. I think risk can be a good thing, but only if it makes sense. And that kind of boils down to your investment prospectus as well as your procedure manual. Those risks kind of boil down to that. So that's why this stuff is important because it will kind of all play together in the end. And you can go back to these things and then, kind of give yourself a little bit of confirmation that you're doing either the right thing or you're doing the wrong thing. So, um, but yeah. So, are you risk on or are you risk averse? I would say the younger you are, the more risk on you should be because you have a lot more time to recoup any losses that you may have took on early on. If you know you're, let's say, like between 35 to 45, you may be still a little bit risk on, but you're starting to diversify a little more into safer assets like bonds or CDs or things of that nature. You're starting to slowly allocate your capital over from equities to safer assets, but I wouldn't say too, like, I wouldn't go too much. I would do no more than 20% bonds between that age. And then once you get a little older, so like 45 to 60, that's when I would say probably every 5 years, you would allocate another 5% to bonds or safer assets, um, or more liquid assets since you're getting closer to that retirement age. Um, and then by the time that you're like 65, you shouldn't have any more than 30% of your capital in equity, I would say by that time. I would say anything more than that, you're that's too much risk because you're at the time point where you need that money because you're going to be retiring. So just like I would say, risk has a lot to play with how old you are, um, as well as just like the type of person that you are. So like you could be young, but you're more conservative, so maybe you don't want to be too risky, which that's completely fine. The examples I gave earlier, that's just complete like that's just my belief. That's not like a set in stone rule or anything. Like you can be young and be risk averse, or you can be old and be risk on. I mean, it's just completely up to you. Um, yeah. Um, but yeah, so basically, the investment objective is a set of goals that determines your financial portfolio. So, and then like this stuff would matter because it's like I said, the foundation of your investments. If you don't have a foundation, then you're gonna be you're gonna be wobbling all the time. You're not gonna be, you know, nice and set and straight. It's just gonna be wobbling all the time. And, volatility is no fun when it comes to investing. Um, but yeah, so like if you're risk on, then I would suggest that maybe growth maybe the route that you take for um, your purpose. If you're, a little more risk adverse, then maybe preservation or income would be your purpose or your goal for your investments. Um, and then as well, you have to the time horizon also plays a factor as well. So I would recommend doing your own research. Like take this stuff, but then apply it to your own research um, to get a better understanding and things of that nature. Because like this isn't like a deep dive. What I'm just trying to get you familiar with this. What I really want you to do is do your own research because that's the best way that you're going to learn. But do your research on the things that I'm talking about. Or if you can use this stuff and then maybe take an even deeper dive and keep going that way. Just depends how much you're trying to learn and how much extra spare time that you have. But um, yeah. So now the next thing that I want to get into is investment philosophy. So investment philosophy. So you have your investment objective. Good. So the objective of your money. What do you want your money to do, basically? Now the next thing that you need to figure out is your philosophy when it comes to investing. So an investment philosophy is like a coherent way of thinking about the markets. So um, and how they work and the types of mistakes that you believe consistently underlie investors' behavior. And so understanding investor psychology was the first point that I made here. So going into that, so finance, there's nothing set in stone in the finance world, in the investing world. Finance is a social science. You have to understand people and understand systems as well when it comes to the finance world. There's no like, it's not this is a rule, this is the way. It's this is the rule or like hypothesis or theory, but then there's limitations and it you like understanding the foundations of things in finance, I would say is the most important part of investing. If you understand the foundation, then you can expand your knowledge even more to like where the path could take you type of thing. So, um, so that the finance is a social science. So psychology actually plays a huge factor in investing. And so I would say understanding investor psychology is an important part of your investment philosophy because if you can understand how investors behave and the way that they would react to certain events, then you can make better, more informed investment decisions just off of that. If you can understand that unemployment coming out hotter than expected would raise the likelihood of the Federal Reserve cutting interest rates, then you could use that information to then put more money into the market because a cut in rates would be a positive thing for equities. So you would put more money into the market before the actual event happens. And then once the actual event happens, then that's when you would appreciate from that knowledge that you had. Um, so that's kind of like why understanding investor psychology is important. That's just an example. As well as that's why understanding like the foundation of basic economics and basic psychology plays a vital role in investing. There's so a lot of people believe that investing is confusing and they believe that they would never understand it. It's really not that hard. There's just a lot of information that you have to take in and try to digest and then make informed decisions based off of it. The actual contents of it is not too confusing. The where it gets confusing is this: there's just so much information that you have to digest. That's where it can get confusing. But um, so yeah, so we use investment philosophy as a way to think about the markets and how we believe that people behave, basically. Um, and then investment strategy is like a narrower way to put it. Um, so it's like putting your investment philosophy into practice, but we'll get into that later. Just for this video, we're just focusing on one and two. Um, but so I would say like the ingredients or like the steps of an investment philosophy would number one be that all investment philosophies begin with a view about how human beings learn or how they fail to learn. So underlying every philosophy is a view of human frailty, that they learn too slowly, learn too fast, tend to crowd tend to crowd behavior. Um, there's there's the herd mentality, then that there's a lot of that within the investing world. Herd mentality is a really big thing when it comes to investments, because you know you don't want to be the only wrong one. It's like if you're doing one thing, but you see everybody else doing another thing, and then you see that your thing isn't working, then why wouldn't you go with the herd? But that's something that you can run into trouble with, though. So definitely be cautious of that. But so yeah, step one is beginning with a view about how human behavior or how human beings learn and their behavior and things of that nature. And then step two, so using step one, you then generate a view about how markets behave and perhaps where they may fail. And then your views on the market efficiency or inefficiency are the foundations for your investment philosophy. So, what this is talking about is the efficient market hypothesis. So, the efficient market hypothesis is a hypothesis that either markets are efficient, where everything, all things accounted for, are reflected into the prices of stock, or markets are inefficient, where what that means basically is that there's times where a stock price could be either beaten down too much or it's been pumped up too much, basically. So what the market, so what the inefficient hypothesis means is that there are inefficiencies within the market. An efficient market means that the market's efficient, and that prices of stock are where they should be at all times. Is like a dummied down version of it, like in layman terms. So your understanding of humans and how they learn and how they behave, you then use that to generate a view about how markets may behave or perhaps where they may fail. If you know anything about humans, nobody's perfect. We are rational beings, but sometimes we can be very irrational. Sometimes we let our emotions overtake our decisions and we make stupid decisions based off of our emotions. That's just being human. Now, you can apply that same knowledge to investing. People are rational, but sometimes they be irrational. They can be very emotional. So what that means, what basically I'm getting to is sometimes we get scared and That's okay. It's okay to be scared, but that can lead us to making irrational decisions. So when a stock price is dropping rapidly, people tend to start selling that stock. But then it gets to a point to where that stock now has become oversold, which then the only way that it fixes itself is that there's buyers out there willing to buy it at the cheap price that it's at right now. So, um, that's just kind of like an example of how human behavior and how we perceive things can kind of tie into investing and the things like that's kind of the thing that I'm kind of pushing you towards is to look for those type of things is where a stock's been beaten down so much to the point where it may be undervalued. But we'll get more into that type of stuff later on. Right now, we're just setting up the foundations of what I think that you should know. So, but yeah, so understanding investor psychology, you can then apply that to if the markets are efficient or not. In my opinion, I believe that markets are inefficient because I believe that I believe that 90% of the people that invest in the markets today probably have little amounts of knowledge of what they're actually doing. I would say only 10% of the investors in the world actually have a true understanding of investing and economics and everything that plays a role into the markets. So, therefore, the markets can't be efficient because not everything can be included into the stock price because not everybody knows what needs to be included into the price of the stock. So, that, and I also believe that there's always buying opportunities out there. I believe that there's assets that can be undervalued by a lot, and I also believe that there are assets that can be overvalued by a lot as well. I believe that the markets are not efficient, but they are inefficient. So, using that knowledge and that understanding of investor psychology and market hypothesis, we then can create a strategy based off of those two things that we can apply to when it comes to our investments. So this is kind of tying back to the purpose of your investments somewhat. So investment philosophies, there's quite a few investment philosophies. Um, just for example, there's value investing, which what value investing is, you're looking for those inefficient opportunities that I was explaining. So you're looking for a stock that has been beaten down and is to the point where it is undervalued based off of the fair value that you calculated for that stock. So there are valuations that you can calculate yourself. But from my first video, if you go through my first video that I posted, that's what that is referring to. The things that I go through in that video is like the that fair value and like all the stuff that I talk about in the financials and things like that and the key metrics. That's what that is referring to basically. So if you use Morningstar, then you can apply like what assets are undervalued and what assets are overvalued. So like the 4 and 5 stars that we narrowed down in the screener, those would more than likely be considered value stocks. So that's what value investing is. You're looking for those 4 and 5 star companies buying in at a cheap price and holding it on for a gain, hopefully in the future. Um, because the stock price is undervalued based off of the metrics that we used. Um, but yeah, so that's like value investing. And then there's, income investing, which the whole purpose of income investing is just gaining capital, basically. So these portfolios be constructed of like mainly dividend stocks. Um, Companies that pay back money to you for just holding their stock. Um, that I mean, it's just steady income, so steady passive income, and then that would also like be considered like passive income as like passive investing as well. So like that's another type of philosophy. Those two kind of like twine together. So you have value income, then passive. Um, so there's like passive and there's active investing. Forgot to talk about this. So passive investing is like buying those dividend stocks that just pay you back money. They're not too volatile, so the stock price doesn't really move too much. You shouldn't expect the stock price to gain in appreciation. The only thing that you should expect with a dividend stock is receiving that dividend. Yeah, the stock price might go up a lot one year, or it might go down a lot one year. Just depends what's going on with the company. That's why staying on top of things is very important. And like staying on top of things is very important. And that's another reason why I kind of said in my first video, that I don't own more than 10 stocks at a time. That's because I do so much maintenance on my portfolio that 10 is probably my max that I could keep track of at one time. Um, but so yeah, I would say there's a bunch of different philosophies out there, like the value, the income, the passive, the active. Like I said before, do your own research on this stuff. Really get a great understanding of it. Um, and like you'll be in a good place starting off as a new investor. These are the things that I wish I knew early on when I first started, because it's like the things I consider the most important to my strategy and the way that I invest nowadays. Um, but yeah, so definitely do your own research, get a great understanding of these things, because these are the first two steps of becoming a successful investor. So I would say these are probably the most important steps here out of this whole thing, because this is like the foundation. This is like the actual true foundation of your investments. Even though everything here is the foundation, this is really like the two most important. So definitely do your own research. Get a great understanding, a great grasp on this stuff. And like I said, hopefully you've been jotting down, notes for each section, or at least thinking about it in your own way. But yeah. If you have any questions, go ahead and let me know. Um, I don't think there's anything else that I wanted to. I think I really covered everything for those two sections that I wanted to talk about. So yeah, um, yeah. So hope you enjoyed, and I'll catch you later. Peace.